Bismillah. All right. Let's get started. Uh, yeah. So there was news today at 8:30 and 10. 8:30 and 10. Let's see. Price action here. So this dark gray, let's say black, charcoal box is a fair value gap, 5-minute fair value gap we highlighted yesterday. Inverted fair value gap we highlighted yesterday, as well as this green. Should have been technically red because it's a bearish 5-minute fair value gap that price reacted to. And it's just been significant for today. It was this charcoal box was also significant for today's price action, as well as this 4-hour fair value gap significant as well. And last night we highlighted the 5-minute fair value gap for an entry, and during the Asia session that proved pretty well. We highlighted these targets here, these swing highs as potential targets, and pretty much all of them except the last two were significant in terms of targeting. So one thing, when the market, whatever day you're trading, you want to kind of like acknowledge the previous day's high, the previous day's low, kind of determine if we are near the previous day's high, previous day's low, or if we are having an inside day, meaning that price is trading inside the range of the previous day. Ideally, we want to take high probability trades. So one thing about high probability trades is that you want to get in, same as anything like overbought, oversold indicators like the RSI or stochastics or MACD, modified MACD, whatever. You want to kind of like get in when price, if you're looking to go long, looking for price to go up, you want to get in when price is oversold, right? And you want to get out once price becomes overbought. In this case, we can kind of determine that just based off of the range, right? So we are in the previous day's range, highlighted here. In this case, you technically don't need to pay attention to any of don't need to pay attention to anything. Believe that. Don't need to pay attention to anything else except, and yeah, I got more than I need on here, but that's all right. So you technically only need, you can take that off too, to know the above the 50%. So we've seen price. So this was high probability down here. Once price got above the 50% mark, now the odds of it going up here decreases. It may still be high probability if it was a strong enough catalyst, but because it's above the 50% of the range, now it's technically an overbought territory, or as we would say, it's more of a premium. We buy everything in a discount, and we look to sell during premium. So the fact it got above the 50% range, then yes, shouldn't be full size in your position, unless you felt like there was a strong enough catalyst about to occur, or you kind of seen something like this here where price traded above a bearish fair value gap, traded below it, technically traded back into this was this 1 hour, technically an inverted fair value gap, 1 hour inverted fair value gap, and kind of held above it. So even with that, still want to keep your wits about you in terms of mind your business, right? Keep your money on your mind and your mind on your business, however that goes. Keep your money on your mind and your mind on your business, right? Worry about yourself. Worry about yourself, right? Lock in your profits, kind of like scale out, leave a small position in that the market is paying for. So, meaning that you are trading the house's money, so to speak, not your own anymore, with those remaining contracts or position size that you have remaining. Once it gets above 50%. So that's like kind of like a review of yesterday's price action. And let's just do this here. Bring it on back. Oh, you can go one by one. All right. So this is what we highlighted yesterday. The price dropped down into a 5-minute fair value gap, and how we also mentioned yesterday that this is more robustly or more significantly is that the 15-minute fair value gap. Bullish fair value gap. We also have a bearish fair value gap, which makes this a balanced price range as well. And you can kind of see like this also coincides with the consequent encroachment of this 4-hour fair value gap here. But let's just adjust that to just show us this 15-minute level, and you can see more accurately the significance of that for today, in conjunction with this higher time frame PD array. So you had an entry here during the Asia session, took out the Asia session high. A retracement down, took out the Asia session high, pulled back into the range into that range. So if you wanted to, and I'm using this swing high here at 215, you could use the Asia kill zone low to the London high, because that is the high prior to the New York AM session. So you have optimal trade entry to the 78.6, and yes, I'm using the wicks only, and we can kind of tighten that up for entry just using the bodies of the candles. And we're using this swing high here now because that is the highest body. And we use this swing low here, and we consider either of these two as an entry, right? Either at 7:55 prior to the news. I wouldn't recommend that. So anyway, price came down, stop run, and you can see it dug down deeper into the optimal trade entry, and deeper into, looks like it hit the consequent encroachment of this 15-minute fair value gap, which is 48.9550. As usual, I'm usually eyeballing stuff, so you can go back and fine tune things on your own if you're following. But anyway, the low on this candle is the same, 48.9550, same as this dotted line, consequent encroachment of this 15-minute fair value gap. So that's pretty significant, and along with the optimal trade entry. And again, this would be your first scaling out. This would be your first target. Second target, one standard deviation would be like a third target. And with your smaller position, you can either target 1.5 or 2 standard deviations, which we reached. And that's, again, I'm not sure if I mentioned that just now, but we want to be aware of the previous day's high, previous day's low, and the range between that, right? 50% of that range, so to speak. in relationship to where price currently is and what our bias is, right? So my bias from yesterday was bullish. I was hoping for it to reach above here, but it didn't. And you can kind of see here, there's a lot of opportunities here. I mean, we can just do this quick. So besides knowing where price is in relationship to the previous day's high and the previous day's low, and sometimes you need to go beyond that depending on where price is, right? Is price above the previous day's high? Is it below the previous day's low? Then you kind of go back the past 3 days. So you kind of determine where is price in relationship to the previous 3 days. And clearly this is the most dynamic price action, and we are having an inside day today. So price is literally inside this price range. But literally this 4-hour level from the previous day and from Tuesday is still significant, right? Besides that, keeping in mind where is the price in relationship to the previous day's range, previous day's open, previous day's low, previous day's high, previous day's low. You also want to be aware of the previous days, or rather the previous session highs and lows. I'm going to take this off for a second. I don't know what I just did, but let's bring that back and let's take it back off. All right. So this blue box is the Asia session. This peach looking pink thing is the London session, 2 to 5. I'm over here like, I definitely had that going further out. Yeah, it says 2 o'clock, but I like to put it at 1 o'clock. Yeah, whatever. Right, so all right, so you got 2 to 5 London session. Then we got 7 to 11 for the New York AM session. You have 12 to 1 or 12 to 1:30 for the lunch session. We have 1:30 to 4:30 for the New York PM session. So yeah, and you can see here, just thinking about in terms of targeting. Here you have price. The London, the Asia session ran below. Oh, we have this run below the PM session lows. You have a trade back above consequent encroachment of the 4-hour fair value gap, and also this balanced price range. Down close candle, up close candle with bearish fair value gap, bullish fair value gap, and significance of that. And so then we have price on the London session running above the Asia session high, traded back down, right? That's an entry. It's really consolidating. Then you have during an AM session a pullback and deeper into the Asia session for an entry, 8:30 news. So you can think in terms of consolidation or accumulation, manipulation, then distribution, AMD. You also have here a midnight open. And if you're bullish, you want to get in below the midnight open. You want to get in below the midnight open if you're bullish. And if you're 8:30 hits and you're still bullish, then you want to get in below the 8:30 open, right? And vice versa. If you're bearish, you want to get in above the 8:30 open, or if you're bullish prior to 8:30, then you want to get in above the midnight open. So you can see here the London high is taken out during the AM session, right? Have a retracement here, filling up this fair value gap. retracement, filling up this fair value gap, stepping back down into this 15-minute fair value gap, and then rallying higher. Also stabbing back down into this 4-hour fair value gap, then rallying higher to take out the lunch hour high. All right, so just again keeping in mind previous day's high, previous day's low, the midpoint between the previous day's high, previous day's low in terms of discount and premium or oversold, overbought, and then also keeping in mind the relationship of the previous session highs and lows and midpoints in relationship to each other for potential entry points. And also keeping in mind the news. So 8:30 was news, and also 10 o'clock was news, moderate news. So high impact at 8:30 and moderate news at 10. So that's what I wanted to highlight there. The significance of that fair value gap and the relationship of different sessions to each other. But also when you have these type of inside days or inside the previous day's range days, then you can see even on the lower time frame the significance of 5-minute fair value gaps. These are the gaps we drew yesterday, excluding this 5-minute gap that we just used the 15-minute gap instead of the 2 5-minute gaps. We discussed the Asia session entry here. We discussed the Asia session low with the London session high for entry during the New York AM session. We discussed some degree of scaling out of positions. If you see like another setup while you are also in a setup, then by all means you can. That is a reason to add to your trade with a different set of risk parameters. Of course, you wouldn't enter up here and have that stop for this trade way down here, unless you throwing caution to the wind, right? That's on you. But if you see another type of trade setup, then by all means, if it's going to improve your life, then go ahead and take it, right? Otherwise, then sit on your hands, wait for another entry. Or not, right? You have to be more selective. Like everything else in life, right? So here we have a run on buy side liquidity here. So we have the entry long during the AM session. We also can do this short position into the PM session during this kill zone as well. So you don't have to put on your trade during the kill zone, but you should be stalking your trade during the kill zone at least. So you can either do like false breakout above this fair value gap. It's already an inverted fair value gap, so we already know that as long as price stays below it, that is a nothing in life is guaranteed, so it's a high probability that price will continue to the downside. And here kind of traded between two fair value gaps. That's okay. But here you have this is buy side liquidity, and this would be SL. Buy side liquidity was rated here. Price dropped back down. We have a market structure shift. Right here. So we have a market structure shift. And what's the rules? We look for a fair value gap that's formed on the price leg that broke market structure or caused a market structure shift. So we're looking for entry inside of this fair value gap. That's pretty much nested inside of this inverted fair value gap from yesterday. So let's change this color so we can. Right, so we have that entry. Our stop will go, in any case, it will go up here. Stop loss up here, and our entry would be inside of this fair value gap. Trade it down into this bullish fair value gap. Sent it back up. Looked like it went to about the halfway mark. That's the halfway mark. Went below the halfway mark. Right here I'm looking at. Anyway, went down, came back up, because now this is what? This was always a bearish fair value gap. So let's, well, traded above it, so it was an inverted fair value gap. So let me just do that. So now we could kind of like, if it trades below, then we should treat it like it's a bearish fair value gap. So you have a retracement into that during the PM session. So looks like this may also be a optimal trade entry long short. Let's make that bigger because we got a lot of weird colors blending together. So yeah, so we have an entry that's using the wicks. If you use the body, would have almost got stopped out here, but you wouldn't have. Would have made me nervous, I tell you that right now. But getting stopped out is part of the game. It's pretty much one of those, may the best loser win, right? Now, winning the loser's game, in other words. Gotta learn how to take losses with a smile and not have it have a high impact on your mindset, on your account size. You know, you got to know when to hold them, know when to fold them, know when to run, so to speak. All right, so we definitely have an optimal trade entry 49, 23, 25, or anywhere along this line, as well as the confluence with the fair value gap. Short, targeting here, next target internal liquidity, this bullish fair value gap. However, in price traded below here, you want to see what price holds above it. So you already know, like me, I'm taking something off here. Why? Because this is already below the 50% of this entire range here. Right? This means you took the short, boom, you got in. Entire range is below 50%. Now it's at a premium now. It went from discount to premium. So yeah, price could continue going down here, but it's not. You know, you probably was targeting these lows here, right? This is doable, it's possible, but the probability is lower because now it's below the 50% mark. It can go, but it has to have a momentum behind it. It has to have a strong enough catalyst to push it back down here. And we already know there's a 4-hour fair value gap, regardless if we were aware of this 15-minute fair value gap. So yeah, that was one entry, and that entry was during like just before lunch, 11:50, technically the 11:50 to 12:10 macro. Right, so that was pretty good. We also see another entry short using this fair value gap. So you got another entry short. Let's take off using this fair value gap. This is nested with this inverted fair value gap we have highlighted from yesterday. Notice I didn't really discuss anything about breakers and stuff like that, but we do have like breaker entries and stuff like that. I just deliberately, I'm not referring to any breakers here or any like mitigation blocks or order blocks on purpose. I'm only focusing on volume imbalances, fair value gaps, and inverted fair value gaps, and optimal trade entries, and ideally trading inside of kill zones, and just kind of like targeting liquidity. That's my thing right there. Like, keep it super simple. As Simon says, shout out to my guy Simon. I hear Simon in my head, like Simon Says, right? Simon Says, the old childhood game, right? Simon Says, don't say your Simon Says, then don't do it, right? And those are the type of relationships you should have to your rules. Your rules is not written in your rules, and then don't do it. Don't do it. So anyway, we have a entry here at 105. Traded back into this fair value gap and this inverted fair value gap. And this is what I mean by so let's say you got in short here and then you shaved off some of your position here, but now this position to this range to this range, it may be may bring you to a discount again. All right, it's above the 50% mark. Optimal trade entry 61.8. So yes, that is a OT, optimal trade entry, as well. And it's just so you make it easier to see where I anchored the fibs at. Bodies, and here's your entry here. 61.8. Right, so optimal trade entry, that's your first target. Yeah, first scaling out, your first target, almost to your second target. Again, but this is a setup. That's one leg retracement. It's your first leg retracement. This is a reason to add to your trade if you wanted to, or more conviction to hold your trade to the downside, at least past this first target. So that would have gave you a little bit extra change here if you just got out here. However, you have another entry, right? So you want to like, there's a reason to add, but again, this needs to be part of your trade identity, your trade identity, and your trade setup, to know when you're going to add to your positions and when you're going to exit from your position in stages or all at once, or when you're going to move your stop loss. All of that should be documented. And literally what I'm doing in these sessions are just playbooking. So I'm really doing this for myself and for whoever else may get some benefit from it. So so this is another reason to add to your position, because this is another range. All right, there's a reason to add. For me, it's a reason to add. Or if you exited the position, this is a reason to, if this is your model, this is a reason for you to take the trade, right? But it's also, you got to think about time, got to think about price. So with that being said, that is where I anchored body to body. And here's your and that's your entry, right? 78.6, or anywhere inside this fair value gap. Let's see what it looks like using just the wicks. Shouldn't be too far gone. So yeah, it stops short of the 61.8, but it is above the 50% range, and you still have your fair value gap to contend with. So this is partially why, you have to trust in your system, know what to expect, and how to calibrate certain things based on what you see in price action. So yeah, this would be an entry short, targeting this first, and then targeting this bullish fair value gap. And you could even go into quarters, about 25% and the like. So if this 15-minute fair value gap wasn't there, but it is, so this would have been first target. This would have been second target. That's without any type of like fib drawings or target projections using standard deviations of the range or whatever. Likewise, you have now that same type of nesting effect of inverted fair value gaps with bearish fair value gaps. And again, same thing here. That same type of energy is right here, right? 15-minute bullish fair value gap with a 4-hour fair value gap. You have a also, you want to treat wicks like they are gaps as well. So where am I? All right, so this is the wick. 50% of the wick is 48.9850. Is that valid? Okay, 48.9850. And that's, you can look right here, that's where my cursor is, 48.9550. And you can see price right here. You can see 48.9850 is where the bodies of the candle pretty much respected. So this would be the close of this candle would be 49.0975. The open to this candle would be 49.0250. So 48.9550. Let's just draw that out and see how that looks. Let's make it fat. No, not too fat. Let's make this smaller again, because we can erase that now. But anyway, it's pretty decent. Definitely respected that 50% level. Didn't close beneath it. All the bodies were above it. Let's get rid of that. And so here you may say, oh, how come this did this, right? You can even do like higher, low, right? But me, I'm looking for where is there a PD array that price reacted to before? And you have one here. Sent price down. You also have one here that price reacted to here. Right? So there's a lot going on here. You can actually use, I don't want to point out anything that may not be accurate. So in terms of my approach, obviously there's breakers there that can there's breakers and order blocks around that we can use that will reinforce the entry models, but I'm trying to not focus on that. So this would be a inverted fair value gap, and you can see price did react in this area before, traded down, traded back up, stabbed through it, came back down, and you can see it now over here trading consequent encroachment. Now you didn't necessarily, let's say that's not clear to you, you can technically choose whatever you want to choose. You can choose this out, probably in a heated battle, I would look for this one, the closest one first, right? And you can see price used it as a booster. And in that case, you can also use your optimal trade entry. The only bodies here. Optimal trade entry 61.8. Oh, you're going to do the wicks. All right, still below the 50% mark, and that's your entry. Now let's say you missed that entry, you can catch this one, all right? Because this is technically when price broke through above it. Now this is an inverted fair value gap. In any case, could have got in here, right here. That's your entry long. It never came back down once you entered. This would be your stop loss down here. Here's your entry, and target this, then target this high. So you would have missed that. Could have got in there. You would have missed that one. Again, this is you targeting now, not just saying like, oh, I want price to go up, but literally you're now targeting these previous swing highs, and you're also targeting ideally the previous session highs and lows. Right, so you got that. You say, okay, I want to be ambitious. I want to target the intraday high altogether. And here's another entry here, and then let's see, literally took out this high and then fell back down. And technically you could have, this is doable. You can actually trade this still. Probably would have to drop down to a lower time frame just so you can have better conviction in yourself. But this is a inverted fair value gap that was sending price down all day. So see price bust through it with some type of force, past the consequent encroachment through the bottom of it. Then yeah, it's nice little short scalp targeting the next fair value gap. Or whatever, right? Midpoint of the range, right? Of this range here. Again, buying in a discount and selling in a premium. And I guess that would be it. Let's turn this on and see how does this stack up to what we were discussing. Right, so you also think in terms of, so besides the previous session highs and lows, you also have to think about the previous session inefficiencies or internal range liquidity, right? Like the fair value gaps, the volume imbalances. So swing high, swing lows would be external range liquidity because it's breaking the range. It's external, it's outside of the range. Internal range liquidity again would be like the fair value gaps, the volume imbalances, the liquidity voids, all those things, the gaps in general, the wicks, all that would be internal range liquidity. Now here to swing low, the wick, the bottom of the wick itself, or signal bar, you want to call it that, that would be external range liquidity. Everything depends on what you consider the range that you're working off of, right? You can use the entire range. You can use the current fractal that price is in, the tighter price ranges that price is in. It all depends on your model. So, but yeah, I'm gonna turn that back off. Yep. And guess that kind of concludes my review. But you have accumulation, manipulation, distribution. Then you have a false breakout, trade back inside the range, failure swing higher into a bearish fair value gap, or the inverted. Is that inverted or is this bearish? Yeah, the inverted fair value gap So yeah, so that's your short. So took out a swing high. Next thing it did, so took out external range liquidity. Next thing it did is take out internal range liquidity. And next thing it did was take out external range liquidity again. So we can do fair value gap to fair value gap, or PD array to PD array, or we can do internal range liquidity to external range liquidity, then external range liquidity to internal range liquidity. Hopefully that's clear.